Hello friends, I hope you're staying indoors, staying safe and your near and dear ones are all doing fine. I also hope that the markets are treating you kindly and you've been able to navigate through the traffic of the market better after having seen my recent videos. Friends, I've been warning you for a while now about how I think the market could witness a decline. However, alerting you about a possible decline does not end my job. As a matter of fact, it would be a job half done. So now that it looks like the market is going to fall, what about providing you with advanced knowledge about how to pick up stocks when the markets actually fall? You see, my 360-degree worldview style of analyzing the market, fortunately or unfortunately, depending on which side of the fence you're sitting on, happens to be a little ahead of the broader consensus, which is why a lot of times what I say seems to be a little unrealistic and therefore it invites very colored opinions and comments. But over a period of time, when things do pan out the way they are expected, not having a game plan to actually do what you need to do once the original expectation has come about would be a criminal waste of an opportunity. So, as the old Wall Street saying goes, why waste a crisis when you can actually make money out of it? So recently, I recorded a video for you wherein I listed out three, from my point of view, of course, the three best Nifty ETFs where you can deploy your money. Of course, that advice still remains relevant for long-term investors. Continue to bite into that investment. But now, in this particular video, I want to tell you how you should pick up very strong stocks in a declining market so that whenever the markets actually finally start to rise, which invariably will, because after every fall comes a rise and after every rise comes a fall. So once the market starts to rise, you're already ahead of the brat pack, which is what I want to do for my viewers, keep you ahead. Even though the advice might sound unconventional and against the grain at the time of you hearing it, but believe me, you will stay ahead. Now, there are four things that I primarily want you to do when you pick up a stock in a falling market. Number one, the stock that you are buying should have a higher relative strength comparative or RSC. Please do not mistake it with RSI. RSI stands for Relative Strength Index. Now, the relative strength index is an oscillator which measures the internal strength of a move of any security that you're analyzing. Relative strength comparative, on the other hand, is the strength of a security versus another security. So, for example, if you're looking at a technology stock like say a TCS and you want to compare it with another technology stock like say Infosys, so you can put in the relative strength comparative study as an oscillator and see which stock between the two is offering higher returns. On the other hand, you can even benchmark TCS, which you want to compare with the CNX IT index, which is the benchmark index of the technology stocks, and see how the individual stock is performing against its index. This is something that fund managers, especially hedge fund managers, do all the time. They are basically interested in buying the strongest stock, obviously for the reason that it will bounce first. Now, those of you who basically are curious about what goes into the study, the relative strength comparative basically measures as to how much the stock that you are analyzing falls against the compared security during a decline and how much it rises during a rally against another stock or an index that you're comparing it with. So the purchase or the buy decision comes only when both the conditions are fulfilled, not one, both. Number one, the stock should fall less in a bear market against the compared security. Number two, the stock should rise more than the compared security in a bull market. So typically speaking, you will see high relative strength comparative stocks bounce back the fastest after a decline is over, and these are the ones that give you double quick returns. Any free technical analysis website will allow you relative strength comparative, and I of course use Reuters software, Metastock, which is the gold standard in technical analysis. That software of course will have relative strength comparative as by default study. So any other software, commercial technical analysis software, will definitely have this study. Please use it to your best advantage. Number 2, it should be a large, preferably a large stock, fairly liquid with a good deal of institutional buying. Now, institutional buying means purchases by very strong hands. Now, these are guys who can average the stock when it falls, who can cushion it from further declines, and since they've already sunk a lot of money into the stock, they will not really let it go down the drain. All right. Number 3, you should basically monitor through the public domain, both on the NSE and the BSE website, including SEBI's website, in a segment called SAST, Substantial Acquisition of Shares and Takeover Regulations. Now, you should keep checking whether these institutional players have started offloading the shares or not. Ideally speaking, they should not be offloading these shares. They should be riding the price down without actually selling. But on the flip side, noting the SAST, or the Substantial Acquisition of Shares and Takeover Regulation announcements, which are updated on NSE and BSE's website every day, if you see that insiders, the company management or the institutional players, buying more shares in a falling market, remain assured you're on the right path, and bigger hands than yours are buying the stock, and they definitely know what the game is. They are seasoned players of the game and they play it well. So you're in good hands and in good company. Then number 4, when the stock is rising, it should ideally rise on good volumes, higher volumes. That tells you that not only is your hypothesis correct, but the market tends to kind of support your theory and seems to be going along with your hypothesis and buying the stock. So they are putting their money where their mouth is, just like you are, and therefore your capital appreciation will be much more quicker in this particular stock as compared to any other stock out there. Friends, I've shared my secret sauce with you about how to pick up stocks just when pessimism starts to set in. Remember, the idea of these videos is to keep you a few steps, if not a few miles ahead of the general consensus. So here again, I'm not telling you to rush into the market just right now. You will basically be receiving a lot more advice from me in my videos. Do keep watching these videos on a day-to-day basis. I will touch base with you and also alert you about when I think would be an appropriate time to go out there and buy. But till then, sharpen your skills, hone your knives, and get ready for the cut. On this optimistic note, I bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comments section, do let me know what you think of this video and what you would want me to record next. And help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. Stay safe, stay indoors. I wish you have a very, very profitable day ahead. Thank you for watching me. Thank you for your patience. Take care. Bye-bye. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.